Welcome to Accounting for Business Decisions A, where today's topic will be on journal entries. First, we'll run through a quick step-by-step guide on how we do them, followed by some examples. So here we go. So let's get to it. What is the journal entry? Accountants have many decisions when it comes to recording the transactions of a business. In this case, the journal entry is a chronological order of business transactions. Here's what it should look like. From the left, we have the date of the transaction. Next, we have the account name and a brief explanation of what the transaction was. Next, we have the debit and credit accounts. Like anything in life, there are some ground rules, just like in accounting. Different accounts are debited or credited according to if they increase or decrease in value. Here's a table summary. For example, when an asset increases, we debit it and put it on the left. When we decrease an asset, we credit it and put it on the right with a small indentation. Let's get started with a quick tutorial on how we do the journal entry. Kate's Catering Company bills a client $5,000 on February 3rd for services in 1 month's time. The first step is to identify what accounts have been affected. In this case, it's accounts receivable and unearned revenue. It's accounts receivable because Kate hasn't yet received the cash from the client, she's simply billed them. Unearned revenue because Kate hasn't yet done the service. So the second step is to identify which account increase and decrease. Accounts receivable increases, so we put it on the debit side. Likewise, for unearned revenue, it also increased, and so we credit it. And lastly, it's recording the journal entry. And this is what it should look like. We have the date on the left, account name, and the amounts that we debit and credit. Notice that the credit has been indented like I mentioned before. Let's try another example. Kate's Catering Company purchases $500 worth of equipment on account on February 5th. So we start with the date February 5th and identify which account needs to be debited. In this case, it's equipment expense, because when expense increases, we debit it. Next is accounts payable, because Kate hasn't yet paid for it, but she will. On to transaction 3. Kate's Catering Company receives payment from transaction 1 on February 6th. Again, we start off with the date and identify what account has been affected. This is cash. Obviously, cash is an asset, so we debit it. $5,000. The next account is still unearned revenue, because it's February 6th and she still hasn't done the services rendered. So we credit it $5,000. Transaction 4. Kate's Catering Company pays her 5 casual employees $300 each for their work in the last fortnight on February 12th. Here's the date and which accounts have been affected. Here it's salaries expense. The tricky part here is getting the right calculation, because Kate has 5 employees and she needs to pay them $300 each for their work. Her total is $1,500. The next account is cash. Because she's paying her employees cash, we decrease it, which means we credit it $1,500. Here in transaction 5, you'll notice that it's an investment cash flow. So here's the date, and the account is cash because she's taken a loan from the bank for $15,000. We debit it $15,000, and we credit notes payable $15,000. Thank you for watching my quick tutorial on journal entries. I hope you were able to learn something out of it.